Hey, and welcome back to our channel. Today we are diving into real estate with only $100. Ready? Let's go! REITs are a very cool tool because you can use them to protect your capital from inflation. After all, real estate rents usually rise in line with inflation. Meanwhile, investors are exempted for services costs such as repairs, security, and property management. Why invest in REIT funds? Let's talk about pros and cons. First, even without having a significant amount of capital, anyone can invest in real estate, since it does not require to have a lot of funds to buy property. Secondly, the shareholders get the opportunity to invest in different types of real estate. For example, ranging from residential apartments to office buildings and warehouses. Third, like stocks to other companies. REIT funds are highly marketable. That is, REIT funds can be easily bought or sold on the stock exchange. Fourth, each shareholder receives their dividends regularly, providing a stable income. However, REITs also have their disadvantages. First, limited growth potential. Public REITs are required to pay out a large percentage of their profits to investors in form of dividends. This leaves little room to expand the portfolio to acquiring new properties. Second, the lack of control over real estate. Investors who invest directly in a real estate have significant control over returns. They can select properties with high cash flow, actually rent to renters, carefully review applications, and implement other management practices. REIT investors, however, are without these options and can only sell their shares if they are not satisfied with the results. So you don't own the property. You are simply investing in the project and don't have the freedom to manage the real estate. And there are some scams. Yes, even in the first field, you can be fooled. So, before investment, research a particular project in detail. The first is by receiving dividends. Dividends are the share of earnings that are distributed to REIT stockholders. These payments can happen monthly, quarterly, or whatever. This makes this matter a kind of passive income. You purchase REIT shares and over time you are automatically credited with profits. The process happens without the need for constant monitoring. You buy and you just get paid. The second one is REIT trading. This is where you buy REITs at a low price and after some time you sell them at a higher value. This method requires a deeper involvement and it is no longer passive. You need to keep track of market changes to keep the most of this way of making money. Which method is better? Here's it all depends on your preference and financial goals. However, I can note that both methods can be used in combinations to maximize profits. For example, let's say you bought REIT shares in March at $20. Over time, their price began to rise. In May, you received dividends and then sold the same REITs for $40. Thus, you profited both from the dividends and from the difference in price in the same time. REIT funds themselves can focus on investment in certain types of real estate. There are funds on the market that specialize exclusively in healthcare properties, warehouses, residential properties, and other categories. You can choose the assets you feel are most reliable and appropriate for your investment goals. Give us a like and subscribe, and I'll see you in the next video.